Well, Michael, let me ask you a question.
Yeah,
One of the
please.
questions, what do you think the institutions should be looking out for when they're entering crypto? Like, what are the key things that they might be looking at?
I think you should treat crypto the same as any other asset class when you're building a financial product. So whether you run a mutual fund or you're going to run a prime brokerage service, for instance, you have to look at how you deal with each asset. We've mentioned custody a few times, but it's super relevant. When you set up a fund, you need to specify in most jurisdictions how you're going to hold the assets. Is it a third-party custodian? Are you going to affect ownership directly? So you have to look at the facilities that are available, the infrastructure available in the crypto world to match what you do today. If you're running a long short equity fund, for instance, like a publicly traded fund. So custody is important. Settlement's sort of built into crypto, of course, because it's the nature of how the ledgers work. It's all in one. You have your transaction and it's settled. The risk management and the quantitative analysis. There's some really interesting projects out here which are taking big data feeds, breaking it down, applying AI to come up with buy, sell, pressure, demand, oracles, and things along those nature. That's not dissimilar to what the large brokerage houses do on New York Stock Exchange or ASX here in Australia. They observe, the buy-sell spread, and they determine what they think the short term is going to be. So I think you take the same approach that you would in any other asset class. You get to understand what's important, because usually it's legal and regulatory driven, right? You must have a custodian. You have to have a way of acquiring these things. KYC, it's the big unknown in crypto, because a lot of the trading is via DEXs and the incumbents do not cover KYC. So what comes of the DEXs when presumably at some point we'll get to a regulatory point, and especially this applies to institutions today. They need to know who they're trading with. So you're not going to have an institution trading on Uniswap because it doesn't meet their KYC needs. So you look for centralized exchanges, or you look at distributed DEXs where identities are known and the parties KYC against each other, or maybe there's a central system. But there's dark trading pools that exist today for non-listed equities in the US, for instance, which work off the same principle. So really, we're looking at the constructs that exist in fiat finance today. The equivalent is in crypto, and then you enjoy the efficiencies of crypto on top. I think it's quite important that we look for infrastructure which institutions don't conceptually already comfortable with, opposed to try and tell them, forget how you do business, this is the new way, because of course the regulators won't do that either. They want to run home to what is known, to what's comfortable, which is fiat. So it's finding the infrastructure in crypto today which matches how they run all their other businesses, all their other business lines. And I think, to your point, the maturity point of the industry, 4 or 5 years ago, we didn't have it, right? 2 years ago, we didn't have it. Uniswap's great, and everyone likes decentralized finance. It doesn't work for institutions. There are solutions that we just mentioned to get around the KYC issues, for instance, that are coming out. There's heaps of DEX projects with built-in KYC, because I think the projects are recognizing how important regulation is going to be. So I think the institutions need to look at the projects that offer the infrastructure to meet what they expect the regulatory requirements are going to be. And personally, I think the bet that the regulations that apply to crypto will look very similar to what they apply to securities. So I think going out there, seeing what's out there, and infrastructure which looks and acts similar, but the underlying asset is obviously crypto. That's what frankly, I mean, we're having conversations with instos. That's what they're doing. And I think it's the right approach. You future-proof if you accept these are going to be security-like in nature, running business the same way that you treat the other securities type trading businesses. And then it just comes down to what's more efficient. settling equities via third parties, and it takes time. You're moving money via SWIFT, takes time, costs money, or you're transacting on a blockchain. It settles in seconds. There's no further settlement required. At the end of the day, for efficiency, blockchain wins, right? So I think if we catch up they're fitting the regulatory mold and getting the right infrastructure, at the end of the day, I think blockchain comes first.